Hi guys, I'm Karunya Rao, and in Ideas for Profit today we do a deep dive into the fundamentals of a leading oleochemical maker, Galaxy Surfactants. The company had a tough time recently given the disruption across the supply chain. Price of its key raw material, lauryl alcohol, which makes up for 50 to 55% of the total raw material cost, had surged from the levels of $1,800 per metric ton in July-August to $3,000 levels. Apart from that, supply of another key raw material, ethylene oxide, was also uneven, which impacted production and margins. So even though Q2 FY22 sales grew by 22%, it was chiefly because of pass-through effect of raw material prices. Volumes, meanwhile, degrew by 7%. Supply chain constraints and delay in availability of critical feedstocks impacted volume growth. Adverse impact at the EBITDA level was worth 20 crores. Though accounting for that as well, EBITDA margins would still have been weak. Having said that, there were few positives as well during the quarter gone by. Domestic market volumes were flattish despite the feedstock availability issue. For the past 1 year, Galaxy has been clocking volumes between 22,000 to 24,000 metric tons for the domestic business, compared to the band of 19,000 to 21,000 metric tons till 2019-2020. Moreover, capex projects for specialty products at Jagadia and Tarapur are now being operationalized in phases and should be fully operational by Jan 2022. The management remains confident about the specialty portfolio's growth prospects over the medium to long term. Key trends backing this up are global growth sensitivity towards environment and adoption of sustainable products, mild surfactants and non-toxic preservatives. Also, behavior change in favor of health and hygiene is likely to sustain. The operationalization of new plants and relatively lower overall capacity utilization of 67% provides enough room to meet medium-term demand. Over the longer term, we remain positive on the company's dominant market share, strategic partnership with MNC clients, R&D focus and a strong hold on the personal care end-user market, all of which makes it a defensive bet in the chemical industry. About two-thirds of the business comes from MNCs and regional majors in the FMCG industry. We particularly like the contractual relation with FMCG majors, wherein due to the long product approval cycle, product quality aspects and pass-through arrangement for raw material costs make it a resilient business with strong earnings visibility. Furthermore, as Southeast Asia gets back to normalcy, management says feedstock availability issue scenario should improve and retain 6 to 8% volume growth guidance. The management has assured that eventually raw material inflation would be passed through. Already, EBITDA per ton guidance remains intact in the range of 16,000 to 18,000 rupees per metric ton. Having said that, there might be an impact of high-cost raw material inventory in the near term. Key risk for the company remains the prolonged slowdown impacting discretionary end of consumption in the personal care segment. In the near term, container availability issues persist and management sees this normalizing in about 6 months. Now coming to the valuations. Shares of Galaxy Surfactants have corrected by almost 20% from October highs and now trade at an enterprise value of 18 times estimated EBITDA for FY23. Given the resilient business model, we see this as an opportunity to accumulate the stock on decline. As all the major personal and home care product players across the world are committed to replace their petchem feedstock with natural feedstock, Galaxy appears to be suitably positioned to meet the demand emerging from the trend.